Hello, everyone. I'm Perna Matthews, Vice President of ETF Product Strategy at Mackenzie Investments. I'm thrilled to be here with you as one of your new hosts on The Invested. Each month, you'll hear from industry experts from Mackenzie and beyond who will share their unique perspectives on ETFs. As the investment industry rapidly evolves and investor needs continue to change, we'll keep you informed and ahead of the curve. Tune in for in-depth discussions, expert analysis, and the latest trends shaping the world of ETFs. If you haven't done so already, make sure to subscribe to The Invested on your preferred podcast player. You're about to hear my conversation with Andreas Rincon, Director of ETF Sales and Strategy at TD Securities. We'll uncover the intricacies of active ETF structures, explore the similarities and differences in trade experiences between active and index ETFs, and examine the impact of trading global equity and fixed income ETFs in a T+1 trading environment. This podcast is for informational purposes only. Information relating to investment approaches or individual investments should not be construed as advice or endorsement. Listeners should seek professional advice for their situation. Welcome to The Invested, a podcast from Mackenzie Investments. My name is Perna Matthews, VP of ETF Product Strategy. Today, I'm joined by Andreas Rincon, who serves as the Director of ETF Sales and Strategy at TD Securities. In this role, he leads the firm's efforts in developing and executing ETF trading strategies, offering insights and solutions to institutional clients. His responsibilities include overseeing ETF market making, enhancing liquidity provision, and navigating the complexities of ETF trading in both equity and fixed income markets. Andreas, thank you for joining us today.
Thank you for having me, Perna. Much appreciated.
The Canadian ETF industry has seen substantial growth over the past decade, both in index, so market cap beta ETFs, as well as the non-market cap beta ETFs, so strategic beta and active ETFs. Let's start there. Can you start by giving our listeners an overview of the active ETF market in Canada?
I think I'll start by saying that Canada is actually a leader in the actively managed space in ETFs. A lot of people don't really know that, but about 30% of AUM in Canada comes from actively managed ETFs. And that's quite astonishing, especially when you compare it to the globe and where ETFs are globally. In the US, it's only 8% of their AUM in ETFs. So we're far and above and ahead of the space, including countries like Australia and in Europe in general. So where active is growing, but in Canada we're far ahead. And even if you look at a number of products, we're almost half of products are active in Canada, which is a big chunk of the products here. So we're a leader, and it also a thought leader in the space, not just in terms of number of products, but also how we work in the space. And this is really across asset classes. You're talking about equity, fixed income, commodities, asset allocation. We see active across the board. Now, there's obviously some tendencies from one area to the other, but really active is across the board in ETFs. And it's really great to see that here in Canada.
Let's talk a little bit more about that. So certainly a lot of growth, as you say, in terms of market share, double, in fact, in the past 7 years alone to that 30% that you stated. So how are active ETFs similar or different than the traditional beta ETFs that many ETF investors have long associated with the ETF market? How are they structured? How are they offered? You've already told us that it's not just equity or fixed income, that they come in all sorts of asset classes. But tell us more about the sort of similarities and differences between how they're structured versus the more traditional index ETFs.
So I would say, in general, for the average user, they're very similar, I would say. Obviously, if you go into the weeds and open the hood, there are some differences, which is what I think you're referring to. So any ETF, really, active or index, can be an ETF series of a larger fund or can be a standalone fund, let's say. And in Canada, you have the option to do both. And it's very common to do both. In the US, it's not as common. The ETF series was historically dominated by a single player. And we're seeing that change slowly in the US, but for the most part in Canada, anybody can do that. So it has been very common, it's become very common to launch an ETF series of an active strategy that was previously offered in mutual fund land and had a track record, had a long-standing following, let's say. So, and also it's often cheaper to launch the ETF series of that existing strategy. So you don't have to redesign something that's very successful already, just offer it in a different wrapper via the ETF. So you have the option to do that in active land, and you also have the option to launch a brand new strategy as a standalone ETF. And we've seen both in Canada, but given the rules in Canada that most issuers are allowed to do so, we've seen a proliferation of ETF series in Canada versus, let's say, in the US, where the rules are slightly different. And speaking of the rules, one of the reasons why active is so popular here in Canada is because of the disclosure rules here in Canada. In Canada, the regulators are a little bit more open to, basically, I would say, more issuer friendly in that respect, in that they allow disclosure in the same rules or have the same rules as mutual funds in terms of disclosure. So they don't have to disclose their holdings on a daily basis. In the US, all ETFs, for the most part, have to disclose their holdings on a daily basis. There is a small subset of actively managed ETFs that do not disclose in the US their holdings on a daily basis. We call these active non-transparent ETFs, but this is a very small part of the world in the US. Most actively managed funds in the US actually disclose their holdings. And this has actually made it much easier for the manager here in Canada. Obviously, when you have a secret sauce as an active manager, you have to be careful about protecting that secret sauce. And the rules in Canada really allow managers to do so, which really frees up that risk for that manager and allows all of the managers to launch actively managed strategies here.
That's lots of great comments. There are a lot that we need to unpack further for our listeners, for sure. Certainly there's been a lot of attention in the media this year around the number of active ETFs coming to market in the US. And for Canadian investors who aren't necessarily as familiar with the Canadian ETF market, seeing those kinds of headlines in the US, I think, is raising some questions with some of those newer ETF users in the Canadian market around the similarities and differences in the market. It's certainly a larger trend in the US, given they're starting from such a small base of active ETFs historically, to seeing substantial growth. In fact, most, if not all, of the product pipelines from the largest of issuers in the US are all active oriented. But I just want to go back to your comments around product structure. And one comment that I've heard from advisors is sometimes around spread conversations between an ETF series and a standalone ETF. And I think it's important we spend just a couple of moments on that. How's that similar or different? Because a standalone ETF typically tends to externalize costs, right? So that's why there's a spread. It's the cost of buying or selling the underlying securities. How's that similar or different to a series? Because we often get asked, well, why is one ETF trading within a certain spread while another might be larger? What could be driving that difference within different product structures?
So on a daily basis, they should be trading relatively similarly. At the end of the day, both structures externalize the cost. So from a market making point of view, it doesn't matter if it's an ETF series or not an ETF series, the costs will still be externalized for that fund. Now, and obviously some of those costs are outside of market making. These are some of the costs come from the fund themselves. But that aside, the quoting and the market making of these funds will be very similar across the board. Now, the end cost to the investor will differ depending on the structure, because as you alluded to, the standalone fund bears its own costs. For the most part, if they're externalized, there shouldn't be as many. But if it is an ETF series, then the cost of the series and on the entire or the larger fund will be borne by the ETF investor too.
That's a great point. So separating the market making component of that spread versus the underlying cost of trading within that standalone ETF and or a a series of a fund. So appreciate you breaking that down, because I think that as we continue to see more products, both in standalone and in series, I think understanding what makes a spread becomes even more important, because especially in active or non-market cap product world, spreads can vary on so many different factors, right? I
Yes.
mean, even turnover within a mandate, or obviously the types of exposures within a mandate. You could have two products sitting in the same SIFC category, but could be holding very different holdings, right? That can obviously drive how you're market making on those products. But to your point, the more similar the exposure, the more similar, at least the market making portion of that spread or cost will be to clients. So anything else you want to add to that?
Yeah, what I would say is that I will always put it that market making is largely a technology business, and our machines don't know if an ETF is active or passive. Let me just put it this way: it is agnostic to the actual strategy who the PM is. What it does know is that there's underlying securities within the fund, and it treats them equally, is what I would say. So when it comes to market making and finding the fair value of that ETF, we would treat them all the same. We will treat
Yeah.
all the costs the same and everything across the board. So there is no distinction from our point of view how we price one ETF over the other. What we care about is the constituents. Now, you did mention the strategies often or sometimes will differ or be slightly different with an active versus a passive product. Naturally, some of the active products tend to be more concentrated. Some of them can have more liquid securities, or not always, but some of them can. So that naturally drives a larger spread in some scenarios. But that's natural. If the passive product had the same basket, it would be largely the same.
Right. So if you're looking at a concentrated index, for example, your point is that a concentrated index ETF may be also larger spread than a broad basket, a broad market index ETF, just as you're
Yeah,
saying an active
exactly.
product would.
So if you have an active product that holds 10 securities and an active product that also holds 10 securities, we will look at it the same. It's more about the composition of the product and what it looks like and what it feels like than actually the strategy in itself. So that's how we look at it, and that's how we drive spreads. Now, obviously, with regards to the conversation of spread, active products are not as often used by other third parties that are not investors, like derivatives transactions and many other players that are involved in index products for the most part. So that often eliminates a layer of liquidity that's provided by these derivatives. But that's only really happening with a certain number of passive or indexed ETFs. Aside from that, what we normally will see is the natural demand and supply of a product, and that's what drives the spread in the market makers, obviously.
Yeah, that's a great point on the type of user or buyer of different ETFs. In active ETFs, you tend to see much more retail advice engagement advisors are buying those products. Do-it-yourself investors are buying those products. Not always the institutional client or other structural usage, as you say, derivatives and other users of index products. So that's a great point to highlight, and how the secondary market can vary between different types of products in the market, and that not all should look the same, right? Not everything should be trading a penny wide, or
Yeah.
can be expected to, right?
Well, many of the US ETFs that people look at all the time, what we call like mega ETFs in the US, that trade and they're used as often as benchmarks for markets, especially in fixed income. They're very common. Many of these ETFs trade well inside their fair value, trade well inside where the underlying securities trade. That's really driven by natural buying and selling from other participants that are not market makers. Now, if you have a product that is truly an investment product, which often is the case with the active ETFs, then the spread that's being shown is really the spread of the underlying basket, which is the natural spread of the ETF. So you can assume that many of the active ETFs will have that natural spread, and also many of the index world too, at the end of the day.
That's a really good point. How do you think about market volatility then, as an advisor? Holding active ETFs, is there a difference in how you should be navigating buying and selling in periods of volatility when you're holding active ETFs versus more traditional broad index ETFs?
I'll go back to my original point in that it's not really about active versus passive. It's more about what's in the basket, what's under the hood. And if it is a more complicated strategy that has the underlying is a little bit less liquid, then other ways to execute should be considered, like a NAV trade or other means to execute. And you obviously have to be a little bit more careful. But that's really not to do with active versus passive, in my opinion. That's more to do with the underlying of the fund themselves. In times of volatility, what I would say is that advisors should really work with their trading desks to make sure that they are talking about trading and trying to find the best way to execute an ETF. There's many ways we've gone through many periods of volatility, and the ETFs have traded extremely well in those periods. Often at times they trade more during those periods. There's more natural liquidity during those points, aka there's more this price discovery during those periods. So the ETF itself is structured, hopefully, by the product teams such as yourself, Perna, in such a way that they will withstand those periods of volatility, and the underlying baskets are easily to trade, so we can all trade them pretty easily.
It's a partnership, really, because you wouldn't be supporting those ETFs, right? If you weren't on your end, your teams weren't doing that check and saying, is this basket going to hold in most market conditions that we're able to support the product? So I think that's the great thing about certainly the ETF operating model and all of our relationships, ETF providers and market makers in this country, is that it is quite a consultative process, right? It's not that we just come to you with here's the product, support it. This is how it's going to go out. You've got time to react, at least to say, okay, there could be some problems here, or there's some considerations that you should be thinking about a little bit more. So I think that is also another check to ensure that the products coming out in ETF are going to be able to sustain, at least in most market conditions.
And what I would say is that the active product sometimes adds flexibility for the manager to navigate those scenarios, which also means add some flexibility to the market makers to navigate those scenarios. A product that is an index product has really no flexibility. It's fairly set. I would say there is some flexibility for sure, but it's fairly set. In an active world, there is more flexibility around what can go in and out of the fund. And that is something that it's clearly helpful to us market makers.
Yeah, definitely. Speaking of, again, this partnership between ETF providers and market makers, you talked a little bit about the disclosure differences between the Canadian and US market. And time and time again, this has come up in the US, certainly, and in Canada over the past decade. It has come up multiple times by a regulator, and just ensuring that the way that the regulatory environment is set up today is appropriate and safeguards advisors and investors in trading ETFs. Can we talk a little bit about that arbitrage mechanism that exists with our market making community to support trader investor confidence in product? Providers like us, of course, send you what we call the PCF, or portfolio composition file, on a nightly basis. You get to see what is held in our products, what's there, and you use that information to make markets. Tell us more about what happens on your side of that, as well as at other desks, and ensuring that ultimately the investor or advisor is getting appropriate trade execution.
Yeah, and that's a key point. No matter if it is an active ETF or an index ETFs, we are getting, for the most part, we're getting disclosure of the holdings on a daily basis. I'll talk a little bit about the process, but that is a key part of the arbitrage process. Like, if we don't know what's in the basket, we obviously can hedge ourselves, can arbitrage the fund. And that's obviously key to the ecosystem. So on a daily basis, how our day-to-day works is we come into the office, and the custodian, so in the case of Mackenzie's custodian would have sent us the daily or the PCF file overnight. That file would be automatically ingested into our systems. Remember, I said that our business is largely a technology business. So it will be consumed by our systems and that automatically uploaded into our market making system. Then what we have is the moment we show up to our desk after some checks and balances, obviously the idea is that we're ready to go and we're ready to make markets on all ETFs. And how we're able to do so, how we're able to arbitrage any real differences in the fair value of the ETF or where we're pricing it is because we have the daily holdings of that ETF. We know exactly what's in the basket. We know where to sell the securities. We know where we can buy the securities within that basket in order for us to be able to price that ETF. So that's how we ensure an orderly market in ETFs and how we're able to post a bid and ask and size on Mackenzie ETFs on a daily basis.
And a great measure to that too is ultimately premiums and discounts, right? The difference between the market price and the NAV over time. And a lot of different data sources have pretty much consistently shown that in the Canadian market, we've seen a fairly tight market price and NAV range, which is great. That means that there is that, that's the proof that there is an effective arbitrage mechanism in our ecosystem that market makers are working to provide best execution essentially on the exposure that is fairly in line with NAV, right? So advisors can find that data on ETF providers' websites. Ask your ETF provider for that information if you do not see it. But that's another measure of long-term success. Again, short-term, there might be differences between market price and NAV. But over the long term, those are going to be relatively in line.
Well, you're very well aware that the market is very competitive.
Yeah,
in Canada.
Absolutely.
So premiums and discounts to NAV are almost non-existent. Yeah,
absolutely. And that is a really great quantitative measure, right? That can be publicly found to support that. So let's turn our attention a little bit to the recent change in our trading environment in North America, and that is this move from a T+2 settlement to a T+1 settlement, which for the ETF or mutual fund buyer may not have necessarily felt, significant, but obviously there are implications to that. All funds and ETFs in this country for quite some time have been settling on a T+2 basis. And at the end of May, all of that moved to T+1. So clients were buying and selling ETFs and funds settling at T+1. There are still many, many markets globally, particularly in Europe, that are trading still on a T+2 basis. Are there considerations that advisors should be thinking about when trading, particularly ETFs that have foreign exposure in them outside of North America?
I think the first thing I'll say is that everything after the transition went fairly smooth. I would say most investors didn't even know or didn't even notice. So that's a good thing, I would say, first and foremost. In terms of considerations, it depends on the investor. It depends on their trading desk. So it's not going to be a straightforward answer, if that makes sense. The reason being that anything really done on the board, or for the most part, any risk trades, are going to be T+1, regardless of the ETF that's being sold or bought. Now, for a lot of the global ETFs, it's become a little bit more tricky because there's a mismatch in the settlement of the securities being sold if there's a redemption and the settlement of the ETF. So what's happened in the market is that there's been a little bit of a funding charge to some degree added to the redemptions or the large sell transactions on some of the international ETFs, especially when it comes to NAV trading. So if you're doing a NAV trade, it will depend on the issuer as to how they want to settle that redemption. For the most part, not all, but many of the issuers in Canada are settling redemptions on global or international ETFs on a T+2 basis, which means that unless the client wants a T+1 settlement and they want to take the funding charge, for the most part, that redemption will settle on a T+2 basis. So I know it's getting a little bit complicated, but at the end of the day, that's where advisors, specifically if they're doing NAV trades or large risk trades on global ETF, they should rely on their trading desks, because that trading desk will have their own way of dealing with that small nuisance or that small difference, really, in terms of do they settle all transactions T+1 or just the global ones on a T+2 basis when a client is selling?
Great point. I mean, this is something we usually say to advisors is if it's over $1 million, there's no harm in checking, at least with your ETF provider, if not your trading desk, on any trade-related considerations. And so we've continued to have that discussion, at least from our perspective, since the end of May with advisors to say, like, it's better to be more sure, get the feedback as you need from capital market specialists at different ETF providers, or certainly your own trading desk for that insight. Can you see us moving to a T+0 cycle? Like, could that be a reality here?
Yes. Yes. So the T0 is a possibility. At the end of the day, what's happened is that a lot of the responsibilities when it comes to settlement have moved from the back office or middle office to the front office. So you've had to shift some of the responsibilities and checks and balances to the front office to actually be able to facilitate T+1. And I think some of them could happen on a T+0. Now, this is not going to be simple. There's going to be many more complications as there was with T+1, but it is, in theory, doable. Some markets are rate T0, so it is not unheard of. And short settling on a T1 basis today is something that it's done. It just takes more work to be done because it's not automated right now for the industry. But obviously, in the same way that we transition from T2 to T1, I do believe that T0 is eventually possible. It just takes, once again, more work from the industry.
Definitely. Well, I think we'll wrap up with a very important question to you, and that is key takeaways or best practices for our listeners when they're looking to trade active ETFs effectively.
I would say, and I'm going to repeat myself, but best practices is what's really important is really to talk to the experts on the trading desk if you have the ability to talk to somebody there. If you don't, you can always talk to the capital markets people or your partners on the issuer side, including McKinsey, to help you with how to best to transact in those ETFs. There are many people within the ecosystem that can help you as an advisor or as an investor, market makers being one, ETF issuers being another, that can really help you understand how to best to transact in those ETFs at any point in time, be it active or passive. There's obviously a solution for all of those.
Andreas, thank you so much for a very insightful discussion today on the growth of active ETFs here in Canada, a compare and contrast on the US versus Canadian markets in active ETFs, and trading considerations and best practices for active ETFs.
Thank you for having me.
The content of this podcast, including facts, views, opinions, and recommendations, is not to be used or construed as investment advice and is not an offer or an invitation to buy or sell any security. The content of this podcast should not be relied upon for any purposes, and Mackenzie Financial Corporation is not responsible for any reliance upon it. This podcast includes forward-looking information that reflects our current expectations or forecasts of future events. Forward-looking information is subject to risks, uncertainties, and assumptions that could cause actual results to differ materially from those expressed herein. Our views are subject to change based on market conditions. Commissions, trailing commissions, management fees, and expenses may all be associated with mutual fund investments and exchange-traded funds. Please read the fund facts and prospectus before investing. The indicated rates of returns are historical annual compounded total returns, including changes to unit values and reinvestment of all dividends or distributions, and does not take into account sales, redemptions, distribution, or optional charges or income tax payable by any security holder that would have reduced returns.